Hey everyone, stop what you're doing and pay close attention because currency wars are back, and China just made a bold move that's shaking the global financial system. It's January 2026, and while many thought the era of currency battles was behind us, recent events prove otherwise. China's latest currency action is sending shockwaves through markets, threatening the dominance of the US dollar and signaling a new chapter in economic rivalry. This isn't just about exchange rates, it's about power, trade, and the future of the global economy. The stakes are high, and the consequences will affect everything from your investments to the price of everyday goods. In this video, we'll break down exactly what China did, why it matters, and how you can prepare for what's coming next. Whether you're a seasoned investor or just curious about the economy, this is information you don't want to miss. Before we dive in, make sure to hit that subscribe button, like this video, and share it with your friends who need to understand what's happening. And don't forget to drop your thoughts in the comments below. I want to hear what you think about this new wave of currency wars. So what exactly are currency wars? It might sound like something out of a spy movie, but they're very real, and they happen when countries compete to make their currencies weaker compared to others. Simply put, a currency war is when nations try to devalue their money to gain an economic advantage. Why would a country want to make its currency weaker? Because a weaker currency makes that country's exports cheaper and more attractive to buyers around the world. Imagine you're selling apples, and suddenly your apples cost less than your competitors because your currency lost value. More people will buy your apples, boosting your economy and creating jobs. But there's a catch. When one country devalues its currency, others often respond by doing the same to stay competitive. This back and forth can lead to a race to the bottom, where currencies lose value rapidly, causing instability in global markets. Currency wars aren't new. They've happened many times throughout history. One famous example is the 1930s, during the Great Depression. When countries devalued their currencies to protect their economies, this led to trade tensions and worsened the global economic crisis. More recently, after the 2008 financial crisis, several countries, including the US, China, and Japan, engaged in currency devaluation to stimulate growth. This period saw increased tensions as nations tried to outdo each other, leading to concerns about unfair trade practices. Understanding currency wars is important because they affect everything from the price of imported goods to the value of your investments. When currencies fluctuate wildly, it creates uncertainty for businesses and consumers alike. In today's world, with rising geopolitical tensions and economic challenges, currency wars are making a comeback. Countries are using their currencies as tools in a broader strategic game, and the latest moves by China are a clear sign that this battle is heating up again. So what exactly did China do? In early 2026, China made a bold and strategic move that caught global markets' attention. The People's Bank of China announced a deliberate devaluation of the yuan against the US dollar, signaling a clear shift in monetary policy aimed at boosting export competitiveness and countering external economic pressures. This wasn't a sudden, sharp drop, but a carefully managed adjustment designed to weaken the yuan by several percentage points over a short period. The goal was to make Chinese goods cheaper on the international market, helping exporters maintain their edge amid ongoing trade tensions and slowing global demand. Alongside the devaluation, China also relaxed capital controls slightly, allowing more foreign investment into its markets while tightening restrictions on capital outflows. This dual approach aimed to attract foreign capital to support the yuan while preventing excessive money leaving the country, which could destabilize the currency further. The immediate market reaction was swift and significant. The yuan's value dropped noticeably against the dollar, sparking volatility in currency markets worldwide. Asian and emerging market currencies followed suit, with some depreciating in sympathy. Global stock markets experienced mixed reactions. Chinese equities rallied on hopes of stronger exports, while US and European markets showed caution amid fears of escalating currency tensions. Investors and analysts quickly interpreted China's move as a signal of escalating currency competition, marking the return of currency wars. The devaluation raised concerns about potential retaliatory actions from the US and other trading partners, which could further disrupt global trade and investment flows. At the same time, the move underscored China's determination to use its currency as a strategic tool in the broader geopolitical and economic contest with the West. By adjusting the yuan's value, China aims to protect its economic growth and maintain its position as a global manufacturing powerhouse. In summary, China's recent currency policy involved a managed yuan devaluation combined with capital flow adjustments, triggering immediate market volatility and signaling a renewed phase of currency competition on the world stage. China's recent currency moves aren't random, they are part of a carefully crafted strategy aimed at securing its economic future and geopolitical standing. Let ES break down the key reasons behind China's decision to devalue the yuan and adjust its currency policies. First, trade balance is a major factor. China relies heavily on exports to fuel its economy, and a weaker yuan makes Chinese goods cheaper and more attractive to buyers around the world. By devaluing its currency, China can help narrow its trade deficit with key partners and support struggling exporters facing rising costs and global economic slowdowns. Maintaining a positive trade balance is crucial for China's economic stability and growth. Second, export competitiveness is at the heart of China's currency strategy. Global supply chains are under pressure from tariffs, rising labor costs, and shifting demand patterns. A weaker yuan offsets some of these challenges by lowering the price of Chinese products in foreign markets, helping manufacturers stay competitive against rivals in countries with stronger currencies. This is especially important as China faces increasing competition from emerging economies. Third, China's currency moves are deeply tied to geopolitical positioning. The yuan is more than just a medium of exchange, it's a tool of influence. By managing its currency, China signals its economic strength and willingness to challenge the dominance of the US dollar. This move is part of a broader effort to internationalize the yuan, promote its use in global trade and finance, and reduce reliance on the dollar-dominated system. Moreover, currency policy is a lever in China's broader geopolitical strategy amid rising tensions with the US and its allies. By adjusting the yuan, China can exert pressure, protect its economic interests, and assert greater control over its financial sovereignty. In short, China's currency actions are a strategic blend of economic necessity and geopolitical ambition. They aim to boost trade, protect export industries, and position China as a dominant global power in a rapidly changing world. China's recent move to devalue the yuan and adjust its currency policies has significant ripple effects on the US dollar, inflation, and the broader US economy. Understanding these impacts is crucial for investors and everyday Americans alike. First, when China weakens its currency, it effectively makes the US dollar stronger in comparison. A stronger dollar means that American goods become more expensive for foreign buyers, which can hurt US exporters by reducing demand for their products overseas. This can lead to slower economic growth in sectors reliant on exports, such as manufacturing and agriculture. At the same time, a stronger dollar can make imports cheaper, which might seem like a good thing for consumers. However, this dynamic is complicated by the fact that China HLSS devaluation is often a response to economic pressures, including inflation and slowing growth. If China's move sparks retaliatory actions or trade tensions escalate, it could disrupt global supply chains, leading to higher costs for raw materials and finished goods in the US. Regarding inflation, China's currency move can have mixed effects. On one hand, a stronger dollar can help keep import prices down, easing inflationary pressures. On the other hand, if trade tensions worsen and supply chains are disrupted, costs for goods and energy could rise, pushing inflation higher. Additionally, a weaker yuan can encourage capital flows into the US dollar as a safe haven, affecting interest rates and monetary policy decisions by the Federal Reserve. Overall, China's currency actions add uncertainty to the US economic outlook. They can slow growth by making US exports less competitive and contribute to inflation volatility through disrupted trade and supply chains. For investors and consumers, this means staying alert to changing market conditions and understanding that global currency moves have direct consequences at home. China's recent currency moves have sent ripples far beyond its borders, prompting reactions from countries and markets around the world. As China devalues the yuan and adjusts its currency policies, other nations are closely watching and responding in ways that reflect their own economic interests and geopolitical concerns. Many emerging markets have felt immediate pressure. Countries that rely heavily on exports to China or compete with Chinese goods in global markets often see their currencies weaken in response. This can make their exports cheaper, but also raises concerns about capital flight and inflation. Some emerging economies have taken steps to stabilize their currencies through central bank interventions or by seeking support from international organizations. In developed markets, reactions have been mixed. The US and European markets have shown caution, with investors wary of escalating trade tensions and currency volatility. Central banks in these regions are monitoring the situation closely, as currency fluctuations can impact inflation targets and monetary policy decisions. Some policymakers have expressed concern that China's moves could trigger a new round of competitive devaluations, which could destabilize global trade. Several countries have also signaled their intent to protect their own economic interests. For example, Japan and South Korea have taken measures to support their currencies and industries, wary of losing competitiveness. Meanwhile, some nations are exploring ways to reduce reliance on the US dollar in international trade, accelerating efforts to diversify currency reserves and promote alternative payment systems. Financial markets have responded with increased volatility. Stock indices, bond yields, and commodity prices have all fluctuated as investors reassess risks and opportunities in light of China EAS currency strategy. The uncertainty has led to a flight to safe haven assets like gold, further boosting precious metals prices. In summary, China's currency actions have sparked a complex web of responses worldwide, highlighting the interconnectedness of today's global economy and the delicate balance policymakers must maintain amid rising geopolitical tensions. China's recent currency moves create both risks and opportunities for investors around the world. Whether you're a retail investor managing your personal portfolio or an institutional investor overseeing large funds, risks include increased market volatility and uncertainty. Currency fluctuations can impact the value of international investments, making returns less predictable. For retail investors, this means the value of foreign stocks, bonds, or funds can swing unexpectedly due to changes in exchange rates. Institutional investors face similar challenges, but on a larger scale, with currency risk affecting global asset allocation and hedging strategies. Another risk is geopolitical tension. As China's currency moves are part of broader economic and political strategies, escalating conflicts could lead to trade disruptions, sanctions, or regulatory changes that impact investments. Investors need to be aware that political developments can quickly affect market conditions. On the opportunity side, China's currency devaluation can make Chinese assets more attractive to foreign investors by boosting export competitiveness and supporting economic growth. This opens doors for investors to gain exposure to one of the world's largest and fastest growing economies. Sectors like technology, renewable energy, and consumer goods offer promising growth potential. Additionally, currency volatility can create arbitrage opportunities for savvy investors who understand global markets. Diversifying portfolios to include assets in different currencies and regions can help manage risk and capture gains from shifting economic dynamics. For both retail and institutional investors, staying informed and flexible is key. Understanding the interplay between currency moves, geopolitical events, and market fundamentals will help you navigate risks and seize opportunities in this evolving landscape. In short, China's currency actions are reshaping the investment world. Those who adapt quickly stand to benefit, while those who ignore the changes may face unexpected challenges. To wrap up, China's latest currency moves are shaking up the global financial landscape. By devaluing the yuan and adjusting capital flows, China is not only boosting its export competitiveness, but also challenging the dominance of the US dollar. This shift is causing ripple effects worldwide, impacting currencies, markets, and investment strategies. For investors, the message is clear: the global economic game is changing fast. There are risks like increased volatility and geopolitical tensions, but also opportunities to tap into China's growth and diversify portfolios. Staying informed and adaptable is more important than ever. I want to hear from you. How are you reacting to these currency wars? Are you adjusting your investments or staying cautious? Drop your thoughts in the comments below. If you found this video helpful, please like it, share it with your friends, and don't forget to subscribe for more insights and updates. Your engagement helps us bring you the latest news and analysis, so let's get the conversation started. Thanks for watching, and stay tuned for what's next.